Today, the debt bomb that no one wants to talk about. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctive Australian flavour. I wrote a piece for 60 Minutes following the segment which aired yesterday, which you can view via the link in the comments below.
For decades, housing loans have been our country's financial bedrock. It means if mortgages now fail, the entire Australian economy is threatened. How much does Australia have tied up in mortgages?
So there's $1.7 trillion held by the banks in mortgages for owner-occupiers and investors. And that's about 65% of their total lending. That's higher than any other country in the Western world by a long way.
Data scientist Martin North of Digital Finance Analytics says the problem is blindingly obvious. Australia is addicted to debt. There's probably no country in the world more susceptible to the ramifications of a housing crash than Australia.
We are uniquely exposed at the moment because as a society and as a government and as a regulatory system, we're all banking on the home price engine. It just goes on giving and giving and giving, right? But it's not going to.
The US housing crash in the mid-2000s was triggered by homeowners forced to foreclose by soaring levels of mortgage debt.
Traders say this is the craziest day they have ever seen in these markets.
Economies around the world
43%
went into freefall.
Everything and more has been completely wiped out.
The Dow traders are standing there watching in amazement.
I'm drawing parallels Australia now and where the US was in 2006 and 2007. We've got a debt bomb, we've got a debt crisis, and at some point it's going to explode in our face. Welcome to our latest post covering finance and property news with a distinct...
Martin streams advice and data to the market based on his surveys of homeowners in mortgage distress. What he's seeing out there are more and more of us going deeper and deeper into the red.
We've got a lot of people sitting on big loans with no ability to be able to service them.
Increasing mortgage distress means a new word is now stalking our suburbs: foreclosure.
I've had quite a few, mostly positive comments on my contribution, so thanks to all those who took the time to message me. And as a follow-up, you can join my live stream YouTube event tomorrow, the 18th of September, at 8 p.m. Sydney time, which is Tuesday evening, where we will discuss the programme and my analysis. Here are the details, and they're also in the comments below. And this is what I wrote. Okay, this ain't sexy, but it could be the most important thing you see this year. Did you know that Australian household debt compared to our GDP is sitting at 120% and is one of the highest in the world? And that's what the latest data from the Bank for International Settlements, the BIS, says. And they should know, as they are the central banker's banker. Now, you might well ask, why is this a problem? After all, in the past decade, the banks have been lending freely, mostly to help households buy real estate to live in or as an investment. And on the back of that, they have been able to increase dividends to their shareholders and inflate their balance sheets, while the bank regulators are saying the banking system is sound. And despite the growth in debt, there is really nothing to see here move along. Anyone holding property, at least on paper, has done well, as much of our wealth is in real estate. As someone who's been watching the debt ballooning for many years, I've become more and more concerned that we are laying a trap which could catch out a significant number of people and have a flow-on effect on our broader economy. Yet the banks continue to say their mortgage loan portfolios are just fine, thanks, despite the revelations from the Royal Commission showing that many loans were written under false pretences and in some cases lenders were simply breaking the law, as the quest for sustained profits overtook their focus on doing the right thing for their customers. Moreover, while loan defaults are still quite rare, when they do occur, no one wants to talk about them, and the default count has started to rise. So when 60 Minutes approached me to talk about the current state of play, I wanted to assure myself that this would be an objective look at the situation we face. And during my discussions over a number of weeks, I was pleased that they did just this. There are more than 3.5 million household owner-occupied mortgage holders across the country, and based on our latest analysis, close to 1 million are struggling with cash flow due to flat incomes, rising costs and higher mortgage repayments, meaning that ahead there is a risk of higher defaults. And at the same time, the regulators, RBA, ASIC and APRA, have finally started to bear down on the banks over free lending practices. And as a result, now lenders are looking much harder at the real costs and incomes of mortgage applicants, all leading to a significant reduction in what I call borrowing power, the amount you can borrow on a given set of income and expenses. In fact, for many, this is now 40% lower compared with just a year ago. Plus, property investors are also crimped by the same rules, just as foreign property investors are also leaving the field. The net result of all this is that demand for property is now falling, more is to come into the market, as some are forced to sell, and so home prices are falling in the major centres. The rate of fall varies, but in some Sydney postcodes we are seeing falls of more than 20% in the past year, and areas of Melbourne and Brisbane are headed the same way. As prices fall, mortgage lending is also stalling, especially investment loans, and I see a spiral down which is becoming unstoppable. Yet many in the construction and real estate sectors and the finance sector just do not want to accept the facts, saying it's a minor correction and prices will jump back up in the spring. In fact, the question now is just how hard prices will fall and where may they end up. And here is the ghastly truth. Property is on an absolute basis valued more than 40% above its true worth. As lending contracts, we think there is a risk we end up over the next couple of years with a major correction to these levels. If that were to occur, this would be like the USA and Ireland in 2007 when the global financial crisis hit. In fact, we could be seeing the same here, triggered by the same lending binge, inappropriate lending standards and poor levels of banking supervision. Last time around, it took a decade to recover, so this could be a long, torrid road. I believe our political leaders and regulators need to wake up and smell the roses, because for those who want to see the signs, the debt bomb is about to explode. I hope I'm wrong at the 40%. It may be less. But the number of people who might default or live in property where the mortgage is worth more than the value of a home could be significant and devastating for the broader community and the economy. It's time for us to wake up from our property-induced slumbers and start planning to handle that debt bomb. If not, GFC 2.0 in Australia is on the cards, and I think 2019 will be the critical year. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. Here's the link, and it's in the comments below. And as always, if you like what you've seen here today, please share and like the post and add a comment or question. I'll read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting that subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.